Two people checked their 401k this morning. The first one, let's call him that coworker who just won't shut up about it, is up massively this year. He owns NVIDIA. He's been telling everyone at the water cooler that artificial intelligence is the future, and if you're not all in, you're an idiot. The second person is you. You did the responsible thing. You bought a boring, diversified S&P 500 index fund years ago. You don't pit individual stocks. You don't watch Jim Cramer on CNBC. You're a sensible adult. And your account is also up, just a little less. But here's the part nobody tells you. You own NVIDIA too. You probably own a lot of NVIDIA. In fact, you might own more NVIDIA than you do of 400 of the other companies in your diversified fund combined. You just didn't know it. If you want to understand why the smartest investors alive are quietly stepping back right now while everyone else celebrates record highs, you need to understand the math behind what is actually happening in this market, because most people are about to get caught completely off guard. This isn't just a story about whether the market is going to crash. Stocks crash. That's historically normal. This is a story about the fact that you effectively only own 7 stocks and the entire system is sitting on a knife's edge. Let's break it down. Let's start with what's actually happening, because the financial headlines are confusing on purpose. As of right now, the S&P 500 is sitting near all-time highs. The Nasdaq is at record levels. If you've been quietly putting money into your retirement account every month, you are winning. Genuinely, congratulations. But here's what most people get wrong. They look at the index going up and assume that means 500 major American companies are all doing fantastic. They're not. Out of those 500 companies, just 7 of them now make up roughly 35% of the entire S&P 500. Just 7. NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, and Tesla. If you add the next 3 biggest names, you're looking at almost 38% of the entire S&P 500 sitting in just 10 stocks. To put that into perspective, in 2016, those same 7 stocks made up about 12% of the index. Today, it's 35%. The concentration has nearly tripled in less than a decade. So when you buy a supposedly diversified S&P 500 fund, you're not really buying 500 companies. You're buying 7 massive tech stocks with a 493-company hedge sprinkled on top for decoration. Pull out your phone and open your 401k right now. I'll wait. If your top holding says anything like Vanguard 500, Fidelity 500, or any target date retirement fund, congratulations, you are a heavy NVIDIA shareholder. Did you choose that? No. The math chose it for you while you were sleeping.
Okay, so we have a concentration problem, but concentration alone isn't fatal. It only matters when something cracks. So the real question is, how expensive have these tech giants actually gotten? There's a metric economists use to measure how expensive the stock market is. You don't need to know the technical jargon, you just need to know that this number tells you, on average, how many years of corporate earnings you have to buy to own $1 worth of stock. Historically, since the year 1880, that number averages around 17. Today, it's hovering near 40. The only time in 145 years of U.S. stock market data that this number has been higher was December 1999. You know, right before the dot-com bubble burst and the Nasdaq lost roughly 80% of its value over the next 2.5 years. Even in 1929, the year of the Great Crash that triggered the Great Depression, this number was 32. Today, we're at 40. Statistically, we are in the second most expensive stock market in American history. Why are stocks this expensive? One reason, AI. The entire bull case for the market right now rests on a single bet that artificial intelligence is going to deliver such massive productivity gains that it justifies paying record prices for everything. And hey, maybe it will. But let's look at how much money is being spent on that bet. Right now, just 4 companies, Microsoft, Google, Meta, and Amazon, are on pace to spend hundreds of billions of dollars on AI infrastructure, data centers, NVIDIA chips, massive cooling systems, the works. We are talking about spending that rivals the entire annual GDP of a developed country like Sweden from 4 companies in 1 year. And this spending is eating their cash flows alive. Companies are burning cash just to keep up with the AI arms race. But here's what nobody wants to talk about. The whole AI economy is starting to look like a snake eating its own tail. Follow the money with me. NVIDIA pledges billions to OpenAI. OpenAI turns around and signs a massive cloud computing contract with Oracle. Oracle then has to raise tens of billions to fund the infrastructure for that contract. AMD gives OpenAI stock warrants. NVIDIA finances companies that exist solely to rent out NVIDIA chips. It's not even subtle. These companies are essentially writing each other checks and counting it as revenue. And what about the real-world results? MIT recently published a study looking at 300 real-world corporate AI deployments. The finding? 95% of the organizations studied are seeing zero return on their AI investments. Not low return, zero. We are spending close to $1 trillion a year on a technology where 95 out of every 100 corporate deployments aren't generating measurable returns yet. Eventually, the people writing those checks are going to want to see the receipts.
Take a breath, because we haven't even gotten to the macro economy yet. And the macro is where things get really dark. Expensive stocks are only justifiable if everything else in the economy is going perfectly. So, let's check on everything else. Inflation is stubbornly sticky, sitting near 3.8% year over year. The Federal Reserve, which everyone expected to cut interest rates multiple times this year, has officially taken cuts off the table. In fact, the bond market is now pricing in a real chance of an interest rate hike. 6 months ago, Wall Street was expecting a pivot to easy money. Today, they are bracing for the exact opposite. That is a massive vibe shift. Meanwhile, the 30-year Treasury yield recently crossed 5%. Why does this matter for stocks? Because when you can lend money to the U.S. government and get paid a 5% return with zero risk, paying 40 times earnings for a tech stock with all the risk in the world starts to look incredibly silly. Bond yields are gravity, and gravity just got heavier. And then there's the debt. The federal deficit is out of control. The national debt is over $38 trillion. The interest payment alone on that debt is now over $1 trillion a year. We are currently paying more in interest on our own debt than we spend on the entire United States military. Ray Dalio, the founder of the largest hedge fund on the planet, recently called this an actual debt death spiral. When a guy with $150 billion under management uses that phrase, you don't have to agree with them, but you should probably write it down. Here's where I really need you to pay attention, because we need to talk about the cockroaches. Remember 2007, right before the housing crash? There were these little tremors, a small subprime lender collapsing here, a weird hedge fund failure there. Nothing big enough to dominate the news for more than a day, but in retrospect, they were the warning shots. Well, we have those right now, and nobody is paying attention. In recent months, multiple companies you've never heard of have collapsed, taking hundreds of millions in bank losses with them. A subprime auto lender filed for bankruptcy after executives fraudulently pledged the same collateral to multiple lenders. Major banks ate hundreds of millions in losses. Auto parts companies have collapsed under massive hidden debt. Regional banks are disclosing bad loans tied to the same funds. Jamie Dimon, the CEO of J.P. Morgan Chase, the biggest bank in America, recently went on camera and said, "When you see one cockroach,
There are probably more. The CEO of the largest bank in the U.S. publicly compared the credit market to a cockroach infestation. That is a bold metaphor from the guy whose entire job is to keep the financial system calm. So, if you're keeping score, we have stocks at record valuations, intense concentration in just 7 companies, AI spending that resembles a circular Ponzi scheme, sticky inflation, a hawkish Fed, a government debt spiral, and credit cracks showing up where nobody is looking.
What are the smartest investors in the world actually doing about this? Because if it was just me yelling on YouTube, you could safely ignore me. But basically, every legendary investor alive is currently positioned defensively. Warren Buffett's Berkshire Hathaway is sitting on roughly $400 billion in cash. That is more than 30% of their total assets, the highest percentage in 3 decades. Warren flat out said he doesn't see an ideal investing environment. Michael Burry, the guy who famously shorted the 2007 housing market in The Big Short, has bought massive put options betting against semiconductor stocks. Legendary hedge fund manager Stanley Druckenmiller just sold his entire massive stake in Alphabet and cut his Amazon stake by 94%. When this many investors, people who made their careers being early but right, are all stepping back at the exact same moment, that's not nothing. That's a blaring siren. Bank of America's chief strategist summed it up perfectly in 9 words. The top is a process. The bottom is a moment. Sit with that for a second. The top doesn't ring a bell. The party drags on for months or years. People get richer, they get cockier, they post their portfolio gains on social media and call you an idiot for being cautious. And then, one Tuesday morning, the bottom happens. It isn't a process, it's a moment. And everyone who was waiting for the perfect time to get a little defensive misses the window because they were too busy enjoying the ride. Look, am I telling you to liquidate your retirement account and sell everything tomorrow? No, absolutely not. Timing the exact top of the market is a loser's game. Markets can stay irrational far longer than you can stay solvent. We could still see another year of upside before reality sets in.
But what you can do is be honest with yourself about what you actually own. If your portfolio is 100% S&P 500, you are not diversified. You are concentrated in 7 AI stocks with a hedge. If your strategy is, I'll just sell when things start to look bad, please understand that human neuroscience won't let you. People do not sell into euphoria, they buy into it. Your future self is going to be exactly as greedy and then exactly as terrified as everyone else. What you can do is the boring stuff. Look at your asset allocation. If you've drifted way overweight in tech, rebalance. Consider equal weight S&P funds. Consider international exposure. Consider bonds. Honestly, consider cash. Cash is currently paying you around 4% risk-free just to sit there. Warren Buffett is holding nearly $400 billion of it. You are allowed to hold a little too. Don't try to be a hero. Don't try to nail the absolute top of the market. Just make sure you aren't the last one standing when the music inevitably stops. Because right now, the music is incredibly loud, the vibes are good, and your coworker is still winning. But remember, that is exactly what the late stage of every financial bubble in history has looked like. You don't get to choose when the moment comes. You only get to choose whether you're left holding the bag when it does. If you found this breakdown helpful, hit the like button, subscribe, and let me know in the comments what the top 3 holdings in your 401k are. I bet you'll find at least one of those 7 tech stocks hiding in there. Stay safe out there, and I'll see you in the next one.